Hello students, welcome to Accounting 2401. This is Principles of Financial Accounting. This is Dr. Mercado speaking. Welcome back to another week, and in this particular week we are going to be covering Chapter 6, which deals with inventories. Okay. In this particular lecture I am going to be going over exercise 6-12, okay, from your homework. Now it is very important that before you begin working on your assignments, like any other week, I do want to remind you to please read the chapter. Okay. Read the chapter, review the PowerPoints before you attempt your assignments. Now, this chapter has quite a bit of calculations that are going to be happening. If you don't read the chapter, you are going to be completely lost, okay? So, in this particular problem, we are going to be covering 3 ways to account for our inventories, okay? So, we're covering the FIFO method, which is the first in, first out method. The last in, first out, which is LIFO, and the weighted average inventory cost methods, okay? So, FIFO, okay? First in, first out, okay? This is the method of inventory costing based on the assumption that the first units purchased are the first units sold, okay? So, the first units in are the first units out. That's what FIFO stands for. First in, first out, okay? And this method of inventory is based on the assumption that the cost of the merchandise sold should be charged against the revenue in the order in which the costs were incurred. Okay, so when we are analyzing these transactions, we have to talk to ourselves and say, what is happening? Okay, if we are using the FIFO method, the first units that we purchase are the first units we're going to sell. So that means that we're going to be selling our oldest inventory. The first ones in are the first ones out. Okay, so let's make a note here. Okay, FIFO, the first ones in are the first ones out. So we're gonna sell the oldest units, and keep the newest. Okay, that's what's gonna happen with FIFO. Okay, now LIFO, last in, first out. A method of inventory costing based on the assumption that the last units purchased are assumed to be sold at the ending inventory is made up of the first purchases. So the last ones in are the first ones out. LIFO. Okay? You sell the newest units and you keep the oldest units. Okay? That's what it means. And then the weighted average inventory cost flow method, it's a method of inventory costing in which the cost of the units sold and in ending inventory is a weighted average of the purchase cost. So for that one, it's a calculated figure. Okay, we have to calculate, and basically we're going to assign a weighted average cost based on all of our purchases. Okay, so that is a different calculation. But what students get most confused with is FIFO and LIFO. Okay, what do I sell? What do I keep? So if it's FIFO, you sell the oldest units and you keep the newest units. If it's LIFO, you sell the newest units and you keep the oldest units. Now, depending on the type of business that you have is the method that you're going to choose. Okay, so let's say, for example, you are selling fruits and vegetables. Okay, do you want to keep the oldest fruits and vegetables? No, you don't. You want to sell the oldest because they're going to spoil, they're going to rot, and you want to keep the newest. Okay? So it just depends the type of inventory you carry. Okay? It's the type of inventory method that you are going to employ. Okay? If it's something to where, like technology that's constantly changing, you want to make sure that you always sell the oldest technology, get rid of the oldest because new technology is coming in. Okay? Like grocery stores, anything that has it's perishable, those you always want to make sure that you always sell the oldest and keep the newest. If it's something that it really doesn't matter, maybe like what can I say, for example, like a plank of wood, you know, a piece of wood that you bought last week is going to be the same piece of wood you buy this week. Nothing's going to happen to it because you have it on storage, right? It's just a piece of wood and they're all the same. So it doesn't really matter if you sell the oldest or the newest piece of wood. You know, they're all being maintained well and in the warehouse. So it doesn't really matter. It's not going to spoil. It's not going to get damaged. Nails or anything that really has it's not perishable or can get easily damaged. Okay, so there's just different ways for accounting for our inventory. Okay, So on Exhibit 1, we have the cost flow assumptions for the three methods that we're going to be covering. Okay, so the first one we have is FIFO. Okay, the cost flow is in the order in which the costs that were incurred. The first items that you buy are the first items you're going to sell. That aligns with the normal process of a transaction. You buy and then you sell. You buy and you sell. You always buy. You buy and you sell the oldest inventory. Okay, that's what's happening. So you buy the goods and then you sell the goods in that same order. Okay, the newest as you're buying the goods, those are flowing through the process, and whatever goes in first is the first one that's going to be sold. They go in that particular order. Now, for LIFO, that kind of switches up a little bit. Okay, the cost flow is in reverse. Okay, so it's in the reverse order in which the costs were incurred. So here what happens is you purchase the goods and then you sell the goods that you just purchased. Okay, so it's kind of like you're keeping the old items that you already had in storage, and as you're buying new product, you're selling those right away. So they're coming in and out, and your old items are just being maintained in that inventory. Okay. For the weighted average, the cost flow is an average cost. So basically you have to do a calculation, and this particular method gives you an average of the two. Okay, so one of them, FIFO is very, extreme. It's okay. We follow the same cash flow or the same flow of inventory that we have. We buy it, and as we buy it, we're selling it. The other one, LIFO, we buy the new products, we sell the new products, and we keep the old in our warehouse. So we kind of like don't touch the old items unless we have to. And then the weighted average is kind of like in the middle of both of these. Okay. So, and we're going to see in the problem that we're going to be covering how the difference between the three methods yield three different amounts. Now, regardless of the method that you choose, it doesn't really matter as long as you are consistent. You cannot be changing. In January, I'm going to use FIFO. In February, I'm going to use LIFO. And in March, I'm going to use the weighted average. No, you have to analyze what kind of business you're running, okay, and which method is more appropriate for you, depending on your inventory. What kind of inventory do you carry? And then from there, you have to determine which is the best method that I should be using to account for my inventory. Okay. So, this is the problem that we're going to covering. It's exercise 6-12. Okay. And it says the units of an item available for sale during the year were as follows. Okay. In January the 1st, we had our beginning inventory. We had 5,500 units at $4 a piece. On February 17th, we purchased 6,400 units at $6 a piece. On July the 21st, we purchased 6,000 units at $8 a piece. And then on November the 23rd, we purchased 2,100 units at $10 a piece. So as you can see, the price, as time passes, the price of our inventory that we are buying is increasing. Okay, and that tends to happen because, prices seem to increase with the passing of time. There's inflation and all of this other good stuff. Okay, so in this problem it says that there are 1,500 units of the item in the physical inventory at December the 31st. Okay, so usually we do inventory once a year, and we try to do inventory usually when our inventory is the lowest. We don't want to go in there and count our inventory when we made some major purchases. So we usually analyze our inventory, and we say, you know what, our lowest time that we're going to have the smallest amount of inventory is this period. Okay, and that is when we go in there and we make our inventory count. A lot of people do this during December, January, depending on if they know that they're going to be doing inventory, they're not going to replenish the inventory. That way they can deplete as much as they can, for when someone goes in there to do the actual physical inventory, they have less to count. Okay, so in this case, at December the 31st, they did a physical inventory and they found that they had 1,500 units of the merchandise left. Okay, the periodic inventory system is used, and we have to determine the inventory cost by the first in, first out method, the last in, first out method, and the weighted average cost method. Okay, so FIFO, first in, first out. Okay, so here we are trying to figure out the inventory cost of those 1,500 units. Okay, we have 1,500 units remaining. We want to know what we should value those 1,500 units at. Okay, so if we have 1,500 units, and let me copy this over from here to here. Okay, that way we can see it. Okay. Okay. If we have 1,500 units using the FIFO method, okay, which units am I going to be keeping in my inventory? Well, according to my note right here, if I am using FIFO, I'm going to sell my oldest units and I'm going to keep my newest units. So I'm going to go ahead and I'm going to look at my table and I'm going to say, okay, I have to keep my newest units. Which are my 1,500 newest units? Well, my 1,500 newest units are from that November 23rd transaction. Okay, so I know that I'm going to keep my newest units. I need to identify which ones are my newest. Well, my newest units are from the November 23rd transaction. Those are the newest units that we've got. Those were the last ones we purchased. So that is my newest units. Okay, I had purchased 2,100 of them. I only have 1,500 remaining. So then my calculation would be I have 1,500 units, okay, at $10 a piece. So then that would give me 1,500 times $10. That would give me a value of $15,000, okay? So, if I was using the FIFO method, which is where you sell the oldest and you keep the newest units, those 1,500 units that I have in my warehouse would be valued at $15,000. Okay? Now, if I'm using LIFO, last in, first out. Okay? The last ones in are the first ones out. Okay, so if I'm using LIFO, I'm going to sell my newest units and I'm going to keep my oldest units. So here we're trying to figure out which units do I keep, which units are in my warehouse. The units that are in your warehouse are the units that you kept. So for LIFO, I'm keeping my oldest units. Okay, so if I'm keeping my oldest units, which ones are my oldest units? Okay. So if I'm keeping my oldest units, then my oldest units are from over here, from my beginning inventory. Those are my oldest units, okay? Let me go ahead and do that, okay? So my oldest units are from January the 1st, okay? I have 5,500 units to start off with. Now I only have 1,500 remaining, okay? 1,500 units out of those 5,500. So for LIFO, I've got 1,500 units. We have the same amount of units left over in our warehouse. But in this case, I am keeping my oldest units, which are valued at $4 a piece. Okay? So if they are valued at $4 a piece, I have 1,500 units and they're valued at $4. My inventory is going to be valued at $6,000. Okay? $6,000. So if you see, in both instances, I have 1,500 units. For FIFO, I am using the price of the last batch that I purchased, which are my newest units. Okay? For LIFO, I am using the price of my oldest. How much did you pay for the oldest inventory that you have? I paid $4. So that is what causes the difference between the two. Okay? Am I pricing it based on the units that I purchased last or the units that are the oldest in my warehouse? Okay? So now for the weighted average, that one we have to get an average of all of my purchases. Okay? So let's do a calculation for this one. Okay? So we're going to get all of these are my units, and this is my cost, okay? So we're going to get 5,500, and my cost was 4, okay? Then we had 6,400, my cost was 6. Then I'm going to have 6,000, my cost was 8. and then I have 2100, and my cost is 10. All I did, I copied this information over here so I can get my cost, okay? Okay, so it's going to be my cost of goods available for sale. Okay. Okay. Let me move this up a little bit. Okay. There we go. Okay. Oh, and what happened? Let me see. There we go. Well, I guess I'm going to keep it like that because if not, this is 1500. Okay. So now I'm going to get the cost of goods available for sale. I have 5500 times $4. That's going to be $22,000. 6400 times $6, 38,400. 6,000 times $8, 48,000. And then 2100 times 10 will be $21,000. Okay. Now I'm going to get a total. How many units did we have in total? Okay. In total, I had 20,000 units. Okay. And for those 20,000 units, I paid $129,400. Okay. So first we figure out how many total units we had. We had 20,000 units. And those 20,000 units cost me $129,400 based on the individual transaction. Okay. Now the problem is saying that you have 1,500 units left over. So out of the 20,000 units that you had, you only have 1,500 left over. That means you sold the rest. So now what are we going to do? Well, now we're going to go ahead and we're going to get the weighted average cost of these units. Okay. So I know that I spent $129,400. I'm going to divide that by 20,000 units. Okay. And then that's going to give me $129,400 divided by 20,000 units. That's going to give me $6.47 per unit. Okay. So on average, I paid $6.47 for each of those units that I purchased. Okay. That's my average cost. Okay. Once you have your average cost, then you can calculate your amount. Okay. So now you know you have that. Therefore, your inventory will be valued at, so we have $6.47, and we're going to multiply it by 1,500 units, and then that's going to give me $647 times 1,500. So your inventory would be valued at $9,705. Okay. So the first one is FIFO. First in, first out. Okay. You sell the oldest units. And I shouldn't do that because it deletes everything. Okay. So for FIFO, you sell the oldest units and you keep the newest units. So they're asking you, okay, we have 1,500 units. Which ones do we have? Okay. So we know that if we have FIFO, I'm going to keep the newest units. So we're going to look at this transaction. Okay. And let me put a text box. So if we're using FIFO, I'm going to keep my newest. Okay. For FIFO, I'm going to keep my newest units, which are at $10 a piece. Okay. If I'm using LIFO, okay. If I'm using LIFO, I'm going to keep the oldest units. So which were the units that are my oldest? Well, those from January the 1st are your oldest. So those are ones I'm going to keep. So if I'm going to keep those are valued at $4 a piece. I'm going to keep out of those 5,500 units, I'm going to keep 1,500 of them at $4 a piece. And then the weighted average cost is basically an average of all of the purchases that you made and their corresponding cost. You get the total units, which is 20,000 units. The total cost, which is $129,400. You divide it and you get the total unit cost per unit of 647. Once you have the unit cost, the weighted average unit cost of 647, you can multiply that by the ending inventory. In this case, your ending inventory is 1,500 units. So 647 times 1,500 units will give you an inventory value of 9,705. So if you can see here, in all of the three situations or scenarios, we are left with 1,500 units. The only thing that changes is the way we account for those 1,500 units. If we account for those using the FIFO method, my inventory is going to be valued at $15,000. If I account for that using LIFO, then my inventory is going to be valued at $6,000. And if I use the weighted average, that will be basically the method that yields a number in between the other two, between LIFO and FIFO. The weighted average cost would give you an inventory value of 9,705. Okay, so these are the three different inventory methods. Please make sure that you understand which ones you sell and which ones you keep for each method. Okay, that's going to simplify a lot of things for you. Okay, that way you can figure out which inventory did I sell and which ones did I keep. Am I keeping my old? Am I keeping my new? Depending on the method that is being used. Okay, so that is basically it for exercise 612. Very simple exercise. It's just kind of like getting your feet wet so you can be able to analyze the information and identify which inventory you're keeping, are you selling, to calculate your ending inventory amounts. If you have any questions or concerns, please do not hesitate to contact me. Please review your course syllabus for my scheduled office hours. There's also tutoring if you like at the CLE lab. We do have an accounting tutors there. So if you want to go out there to the CLE lab and get extra help, that is highly encouraged and recommended. But if you're struggling, I'm also here available to help. Stop by, call, send a message, whatever helps. Just make sure that you show your work. You include your problem number and your specific question so I can address them on your messages or emails. Okay, so that is basically it for exercise 612. Until next time, have a wonderful rest of your day.